One thing I learned most critically during my 18 years running JP Morgan Chase was this: a market rarely shouts about an approaching risk. It whispers, it signals, and the people who never learn to read that signal find themselves with very little time to react once they realize what's happening. Now, standing at the threshold of 2026, what I'm seeing in 5 separate states has moved well beyond a whisper for me and reached alarm level. But before I begin, let me clarify one thing. None of the states I'll be talking about today are bad places to live. They have beautiful communities, good neighborhoods, decent people. That's not the point. The point is this: buying a home as a place to live is one decision. Buying that same home as a capital investment is an entirely different one. And from a purely financial perspective, buying real estate in these 5 states in 2026 could mean putting decades of accumulated savings at serious risk with a single signature. I have approved more mortgage loans than any other bank CEO in America. We have financed millions of homes across every state. I have seen markets both in expansion and right before collapse. And based on those experiences, I'm telling you this: the patterns that emerged in 2005 and 2006 are beginning to reappear in certain states today. Not everywhere, but in specific markets, in specific areas, the fundamental indicators have drifted so far from reality that nothing could convince me to put my own money into these regions. Let's start with the first state, California. During a risk meeting last year, as I reviewed the data presented by my California housing team, a noticeable silence fell over the room. The median home price in California had reached $830,000. Not Beverly Hills, not Malibu. The median, the exact center of the market. But that wasn't the number that stopped me cold. I examined the debt-to-income ratios from our mortgage team. The average California buyer was borrowing 6, 7, even 8 times their annual income. This isn't a rational home purchase, it's a wager. It's not home ownership, it's speculation, on the premise that prices will keep rising indefinitely. And the foundation that wager rests on is simultaneously weakening on 3 separate fronts. The first front is tax burden. With the combined effect of federal and state taxes, high-income individuals in California face total tax rates approaching 50%. That money isn't going toward mortgage payments, savings, or wealth creation. It simply disappears. It exits the system. The second front is the construction side. For years, California has effectively made new housing production impossible through environmental regulations, zoning restrictions, and union cost requirements. The result is not a genuine shortage, but an artificial one. And artificial shortages disconnect the price discovery mechanism from reality. The third front is the demographic truth nobody wants to say out loud. California is experiencing net outmigration for the first time in decades. Individuals are leaving. Businesses are relocating their operations. The tax base is shrinking, yet the pension obligations, infrastructure liabilities, and social expenditures on the state's balance sheet are not shrinking at the same pace. At JP Morgan, we always track population flows as a leading indicator. The California data has been pointing in the same direction for several consecutive years. Net outflow. International immigration may appear to be balancing the population, but these individuals are not buying $800,000 homes. They are living in rental units. When I look at the California housing market, I see a market priced for perfection while operating under serious structural pressure. What happens when things don't go perfectly? Markets always respond the same way, with a sharp and unforgiving correction. The second state, New York. I've been observing Manhattan from my office for years because JP Morgan is based here. I follow this market both from the inside and through real-time data streams. The median apartment price in Manhattan has surpassed $1.2 million. The median household income is around $65,000. If you try to fit those two numbers into the same equation, the math collapses. What's keeping the market afloat is not local buyers. It's an extremely narrow segment of ultra-wealthy individuals, many of them foreign, many of them using real estate as a store of value rather than a place to live. And this segment does not constitute a reliable buyer base. Rising geopolitical risks, currency volatility, changes in cross-border capital flows, or revisions to tax treaties. Any one of these could evaporate that demand overnight. When that demand pulls back, there is no domestic buyer pool deep enough to sustain current price levels. We're already seeing it. Listing periods are getting longer. Price reductions are increasing. Unsold properties are sitting in portfolios. The luxury segment, the locomotive that drives the entire market, is visibly slowing down. Once you move outside New York City, the picture weakens further. In Syracuse, Rochester, and Buffalo, populations are shrinking, infrastructure is aging, and the tax burden remains significantly above the national average. New York State has built a vicious cycle for itself. It needs higher tax rates to fund growing obligations, but that tax pressure is driving away the high-income individuals who finance those very obligations. In banking terms, this spiral has a name, death spiral, and real estate values always erode within this spiral. The third state is going to be controversial, I know, but the data leaves no room for debate. Florida. Over the past few years, Florida became the primary destination for real estate investment capital. The absence of a state income tax, combined with pandemic-driven demographic acceleration, caused prices to reprice aggressively. On the surface, it looks like a success story, but once you examine the data, the way our analysts at JP Morgan do, a very different profile emerges. The first breaking point is the insurance crisis. Homeowners insurance in Florida is no longer a standard line item expense. It is, in the full sense of the word, a crisis. Annual premiums in most areas have climbed to $8,000, $10,000, sometimes over $15,000. These figures add $1,000 or more per month to the total cost of ownership. It's as if you're taking on a second uninsured mortgage on top of the property itself, and this cost isn't static. It reprices upward every single year. Climate change, hurricane risk, fraud losses, and private insurers withdrawing from the market. The state-backed insurer of last resort is already underfunded, and taxpayers will be left covering that gap. In our risk models, we no longer evaluate Florida real estate based on nominal price alone. We assess it based on total cost of ownership, with insurance costs included from the start. And that single variable alone is enough to completely upend the affordability equation for many properties. The second problem is the fragility of the migration story. Those who moved to Florida during the pandemic were largely retirees and remote workers, a narrow and variable demographic. That base is shifting. As remote work policies reverse and the reality of Florida summers becomes apparent, reverse migration signals are already beginning to emerge. The third issue is structural economic vulnerability. With Florida's economy so heavily tied to tourism and real estate itself, when housing cools, the domino effect will be severe. Construction slows, retail falls, tax revenues shrink, and this cycle continues accelerating downward. A state that has grown too fast, built too much, and attracted too much speculative capital. When those three factors converge, history consistently delivers the same outcome, a sharp correction. The fourth state will surprise many of you, and I believe it's the most unexpected name on this list: Texas. Texas has been a symbol of economic success for decades. No state income tax, business-friendly regulations, strong job creation, and more accessible housing prices compared to California and New York. But risk often doesn't emerge from weakness. It emerges from excessive success. Over the past 5 years, Austin's price-to-income ratio has nearly doubled. Dallas and Houston are following the same trend, though at a slower pace. We're seeing California-level price appreciation without California-level incomes to support it. Infrastructure is failing to keep pace with this growth. Traffic is at a breaking point. The electrical grid has repeatedly proven itself unreliable. Water resources are under strain. And when you look at the bigger picture, there is a systemic question mark hanging over Texas energy. The Texas economy is deeply intertwined with oil and gas, but these sectors are facing long-term structural transformation pressure. Renewable energy, electric vehicles, shifting global demand patterns. These trends do not favor traditional energy states. In closed-door conversations with senior executives of energy companies, I consistently hear the same thing: no sudden collapse, but a slow and gradual long-term decline. The ripple effects of that decline on the Texas economy will eventually eventually reach the housing market as well. On top of that, there are political level risks. The low tax, low regulation philosophy has produced an infrastructure deficit over the years. Roads, bridges, schools, water systems, electrical grids, all of them require significant capital injection. That funding will come either through higher tax rates or increased borrowing. Both scenarios are bad news for property values. The fifth and final state presents perhaps the clearest case, Illinois. The structural problems of Illinois are no longer a hidden risk in financial markets. They are an open reality. 8 consecutive years of population loss. Some of the most poorly funded pension systems in the country. The state is practically at the edge of insolvency, and everyone knows it. At J.P. Morgan, we have been carefully and gradually reducing our exposure to Illinois municipal bonds for years. We no longer believe they can meet their long-term obligations. When a government can't pay its bills, that outcome inevitably flows through to real estate values. Look at Chicago. It still has strong commercial centers and high-value districts, yes, but crime rates, tax burdens, and political dysfunction all at once. The educated young population is gravitating toward lower-cost states, with more opportunity, and the return rate remains limited. Businesses are relocating to cheaper, more business-friendly states. Retirees are choosing tax-advantaged locations where they can preserve their net income, and this process feeds on itself. The more people leave, the smaller the tax base becomes. The smaller the tax base, the greater the burden on those who remain, and the greater the burden, the more people leave. You don't need a doctorate in finance to understand what this spiral does to the housing market. Fewer buyers equals lower prices. Now let me talk about why these warnings are so critical and why timing matters more than anything else here. The real estate market operates on much longer cycles compared to the stock market. Once a housing market turns, it can stay down for years, sometimes decades. A significant portion of investors who bought real estate in Japan in 1989 have still not recovered their losses. Properties purchased in parts of the Midwest in the early 2000s never fully recaptured their equity. The fundamental misconception people fall into repeatedly is assuming that real estate appreciates under all conditions over the long term. That is only true for growing regions with economic vitality. In declining areas, real estate can erode wealth across generations. Right now, at the threshold of 2026, we are at a critical turning point. Interest rates are still elevated. Affordability is at its limit. Credit conditions are tight. Stress is accumulating across most markets. The wrong decision in the wrong place can set you back 10, 15, maybe 20 years. Across all 5 of these states, I see a shared set of common denominators. All of them are overpriced relative to local incomes, and when price-to-income ratios stretch too far, correction becomes inevitable. All of them face structural economic challenges that won't be resolved quickly. These are not temporary fluctuations, but long-term trends. All of them are experiencing either clear-out migration or a slowdown in in-migration, and the demographic picture impacts real estate far more deeply than any other single factor. All of them carry high holding costs driven by taxes, insurance, or regulatory compliance burdens, and all of them operate within a policy environment that is either hostile or unpredictable when it comes to wealth creation and business formation. So what should you do? Where should you look if you're thinking about real estate investment in 2026? Focus on markets with young and growing populations, business-friendly environments, diversified economies not dependent on a single sector, reasonable tax burdens, and sustainable fiscal positions. North Carolina, Tennessee, Georgia, certain markets in Arizona, and select areas of the Mountain West currently meet these criteria. But even in those locations, caution is required. Location alone is no longer sufficient. Look at job growth trends, not just current figures. Look at age demographics, not just total population counts. Look at business formation rates, not just current employment levels. Look at infrastructure investment commitments, not just existing amenities. And always run the numbers with conservative assumptions. Higher interest rates, higher taxes, higher insurance costs, lower appreciation rates. If it doesn't work under a conservative scenario, don't take the step. The housing market benefited from an extraordinary extraordinarily supportive environment for the past decade. Low interest rates, aggressive monetary expansion, and demographic tailwinds all pushed from behind. That wind has reversed. Rates are high. Monetary policy is tight. Central banks are contracting rather than expanding their balance sheets. And demographic flows are no longer supporting prices across every market. In this new environment, the margin for error is far smaller. The wrong decision could cost you hundreds of thousands of dollars. A well-positioned decision, on the other hand, can lay the foundation for long-term financial stability. In 2005, we were telling people that housing prices were unsustainable, that credit standards had loosened dangerously, that a serious correction was coming. Many people ignored it because prices were still rising. Now the same pattern is reappearing in different markets. The warning signs are clearly there for anyone willing to see them. The question is, will you see them this time, or will you only understand once everyone else already has? The choice is yours. Make it wisely. Your financial future depends on it.